Hey, what's up, everyone, and welcome. Today, I'm very excited to share with you an idea that I recently had. Originally, this just started for fun, and it kind of grew legs, and I wanted to better explain the concepts and the ideas. And honestly, the more that I worked through developing it, the more that I felt like it was a really good way for me to better explain the investments training program that I offer. Now, this video is completely free. These concepts and everything that I'm about to share with you, I'll put the link down below the video so that way you can get a copy of all these materials. This really stems from my background. If for those of you who know me or you don't, I coach an investments training program, or I provide an investments training program that I coach. And my background is actually in corporate finance. So I know for some of you that probably seems kind of weird. Well, what's a corporate finance guy doing talking about investment? Well, back in school, when you're taking finance courses, they teach us a lot of the same concepts. And I was always very highly motivated for investing. My father did investing for a while, my grandfather did as well. And it was always something that I was really interested growing up, how it works and how to manage other people's money or how to grow your own. So when I went off to college and I went to grad school, those were the types of concepts that I was looking into. But for those of you who know, it can be very difficult breaking into the investment banking world or working in that sort of investments realm without essentially becoming a salesperson and having to push products that those financial institutions want you to push, which many of them are great products, but that just never felt like the path for me. I steered more towards corporate finance, and then I ended up working in manufacturing finance for the last 10 years, where for 4 years of that, I was a manufacturing controller. One of my favorite parts of interacting with cost in a manufacturing setting was this lean manufacturing system that we leveraged. We leveraged what was called world class manufacturing, and it's this methodology that has all these different pillars, and within each pillar, there's all these 7 step methodologies, and each one is supposed to help you progress a certain area of the plant to create efficiencies or to create cost savings or to just simply drive improvements. So, it was something that I really became obsessed with over the years in terms of trying to be able to translate that information because, as many of you know, especially if you've worked out on a manufacturing floor, there's an abundance of lean manufacturing systems out there. And it really comes down to what are you applying? Are you actually applying the principles or are you just filling out the paperwork? Because I worked at a number of different facilities and the ones that just filled out the paperwork never made any progress. But the folks that were committed to making an improvement, the ones that wanted to leverage these ideas for themselves and try to continue to push the envelope and improve the products, those plants saw leaps and bounds in terms of their improvements. So, what this really stems from is a desire to create a system around investments that's intended more for beginners to help give you the framework to understand what it is you need to know, what it is the financial professionals know, and how they apply it, and how you can take those same concepts and learn how to apply them to your own investments. So stay tuned. I'm glad you're here. I'm glad that you chose this video, and I look forward to walking you through these concepts. All right, so I want to cover initially the pillars. So, this is the view of world class investing that shows you all the different pillars, as well as what I'm referring to as the foundation stones. And we're going to go through each one of these in detail. But as you can see here, there's 9 different pillars. There's organization, which is all about determining your strategy, cost and stats, which is about reviewing investment performance, risk, which is about optimizing your portfolio and learning how to diversify that. Then we get into the management foundation pillar, where we go through the regimen pillar, the quality pillar, which the regimen pillar is all about portfolio maintenance and how you're maintaining those things over time. Quality is about reviewing the performance of your portfolio and the assets within that, and then understanding, are there alternatives that could work better for you? Logistics, that's all about understanding the fees, the penalties, the taxes, the movements of these transactions and how your money is moving. Then we get into more so how to grow over time, which is studying trends that will help you support things like early adoption. Then we get into people or, better understanding who's running these corporations and, understanding that you can follow these people on social media. And then we get into the last pillar, which is feedback, which is all about building an investment network. So let me expand on these ideas just a little bit more in terms of the foundation stones. So the foundation stones for the build stone are the first three pillars, which again are organization, cost and risk, organization, cost and stats, and risk. So the build foundation stone is all about determining your strategy, selecting your assets, and constructing your portfolio. Here is where you want to maximize your returns and you want to lower your risk. So this foundation stone is all about constructing that vehicle, that investments vehicle that you intend on producing, which is ultimately your portfolio. From there, we go into the second foundation stone, which is to manage. That's pillars 4, 5, and 6. That's regimen, quality, and logistics. Those are all management practices. So it's all about high performance and about driving consistency through developing good habits. And then from there, you also want to know how to review asset performance. And what's really key is knowing when to be able to make, when's the right time to make changes in your portfolios in order to maximize those long term investments. And then the last foundation stone is called grow, which is pillars 7, 8, and 9. That's early adoption, that's people, and that's feedback. So growth is never linear, and your returns won't be either. But by trying to build a support network around you, you'll really learn how to leverage those different individuals and how to thrive with growing your own investment. And then I'll just go back here for just a second. If you look at the original picture here, you'll notice that all of these are on the foundation stone of Portfolio Degree. Now, Portfolio Degree is the basic investments training program that I offer. I have a set of training videos that you can pay to unlock. But if you're more curious about what the concepts are, I have a website. It's called portfolioexaminer.com. You can go there. You can use all of our tools. There's 7,300 assets that you can use. It's all for free. You can try out our methods. I've kind of gone back and forth in terms of how I wanted to provide this platform. Ultimately, I decided to make it free because I want all of you to be able to go there and interact with these tools and understand what it is that I'm trying to get everybody to understand, especially with some custom aspects to it, which are asset grades and portfolio grades. We'll get more into that in a little bit. But ultimately, that foundation stone of Portfolio Degree, that's going to give you and help you learn the basic principles that finance students are taught at universities. They're fun methods that help you learn how to easily build portfolios and reduce risk. And then it'll allow you to really develop a foundation to grow from as you're learning how to manage your investments. Now, full disclosure in terms of me and what I offer, I have the Portfolio Degree training videos. A lot of people express that they don't want to be reading materials, they would rather watch videos. So I created a set of training videos. Now, it's not like this. This is off the cuff. I don't have a script here or anything that I'm reading. I'm just saying whatever comes to my mind. Now, those training videos are something that I worked on for about 2.5 years in great detail, where I recorded them and re recorded them and re recorded them until I felt like it was conveying the right information in a proper manner in a way that was understandable to others. So be sure to take a look at that. That's really throughout this whole program. That's the only thing right now that I'm making any money off of is those training videos. And then I also do on-site visits. So if you or your team, especially if you're in a manufacturing environment, if this resonates with you and you want me to come on site and coach you and your folks how to manage your portfolio from these methods, certainly I'm happy to consider those types of things, and I'll put my information down below. So if you want to reach out to me or contact me about that, I'll have my contact information in the comments down below. So with that, welcome. Let's jump into each of the individual pillars. Okay, so the first pillar I'm calling organization. Now, if you're familiar with the world-class manufacturing concepts, the first pillar there is also organization. You really have to understand what in that concept, it's you're understanding the layout of the plant. You're understanding where everything is positioned and how people are doing their jobs. So, from an investing standpoint, organization is all about understanding what is your goal and what are you trying to do by making this investment, by creating this portfolio. You say you want to invest in stocks. That's great. A lot of people are going to tell you that that's very risky, but you can do that, and there's a lot of financial professionals that do it and do it well. So, how do you do it? Well, step one is getting organized. It's trying to understand what is your strategy. Now, you might say, well, Matt, I'm new to investing. I don't even know anything about strategies. What strategies are even out there for me to leverage? Well, over at that Portfolio Examiner site that I mentioned, we have 1,225 test funds. We update them weekly. It's a variety of different strategies that we test so that we can understand what's performing and what's working in terms of asset selection for building your portfolios. Ultimately, we've really refined that testing over the last number of years. And I've kind of realized that really what it's telling me and what it's doing is it's showing me where Wall Street is moving their money. Because as these large hedge fund and mutual fund managers move their money around between different assets, they have to keep their money in the market the vast majority of the time, especially the ones that work for the large investing houses. So they have to find somewhere to park it. So a lot of times when the market is dipping or going down, or there's certain areas, industries of the market that aren't doing so well, by understanding these test funds and what they're telling you, oh, it's leveraging this metric or that one, you can begin to understand how Wall Street is viewing the market, the lens that they're looking through, and where they're moving their money and why. I posted a number of videos over the course of the last month about managing investments, and I'm going to post some more shorts here shortly. So be sure to subscribe to my channel because I'll give you a lot more tips about how to do that without having to subscribe to the full training program. But ultimately, if you want access to all those test funds to be able to see what's working, all that's free. You just have to go over to portfolioexaminer.com and you can create a free account. Now, beyond just understanding, picking a basic strategy, some other elements that you might consider and think about are how many assets are you including in your portfolio? What sort of view is that historical time period for the data? So, we're going to be constructing a bunch of metrics or statistics that are leveraged in for asset selection. So, understanding the historical time period or how much history you're including in calculating those metrics, that's important as well. And that's not something that the Main Street websites allow you to change or modify. A lot of them won't even tell you what they're using for calculating the returns, and it definitely makes a difference. Especially, you can browse through our testing, and you can see that the historical time period and which one is performing best changes over time. Sometimes it's a short-term view, sometimes it's a long-term view. So that's a factor that you need to consider. And then ultimately, when do you come back to your portfolio? When do you check back with it and potentially rebalance it or add or remove assets? A lot of people, it's popular to day trade, it's popular to buy these options trading programs and things of that nature. But the reality is, at least based on our testing, if you're trading more frequently than about once every 2 weeks, you're probably doing it too frequently to actually create any value. But that's also something that we test and we look into to validate that. Is that always the case? And lately, especially with the current market conditions, it's been pretty volatile. That has been the case. Is about every 2 weeks we see that they kind of hit that point of maximum return where it makes sense to engage in a transaction. Now, if the market's down, you don't have to. You can wait another 2 weeks to see what happened. But just know that in terms of organization and constructing your portfolio, we have a lot of tools that you can leverage that can benefit you throughout this process. And then, producing consistent returns, it's all about leveraging a process, which is what we're offering here. And the stocks, and part of why I'm offering you a process, a lot of people come to me and they say, Matt, what's the hot stock right now? Who's the best person that I should go and invest in? Oh, should I go and get this company or that company? Which one's better? That's not the point of what I'm doing here. I'm not the, oh, choose this stock or choose that stock or here's this one's going to 10x. There's lots of those people out there. You can go and follow them. I'm not about that. I'm about a system to help you understand how to trade because the stocks that you own, the stocks that you have in your portfolio, that's going to change over time. And if you're not changing it, you're probably losing out because that company that you bought that was going to 10x, maybe it has. Maybe you're still sitting on it. Why are you still sitting on it? There are other investments, there are other opportunities that are out there that can perform better for you. So you need to begin to consider that. Now, how do you do that? That's really where the second pillar comes into play, cost and stats. How do you look through the data and identify the things that are going to help you select the best assets? So, what we have within the portfolio degree program is what I call the fundamental metrics. There's really about 5 metrics out of all of them that we've tested that really do perform consistently the best and provide the best returns in terms of using them for asset selection for our portfolio. Now, we test a wide variety of them, but the ones that we publish the statistics on are expected return, alpha, Sharps measure, Trainer's measure, and then just an average of those other four metrics. So it's been something that has been really powerful because what we do is we take those metrics and then rather than force you to understand, oh, this one is 0.58 and this one is 0.62. You're new to investing. You might not even be a math person or like numbers. What does that even mean to you? So what we do, and the question that came up for me a lot in grad school was, well, okay, yeah, one number is higher than the other, but how do I know within the greater marketplace? How do I know if I'm making the best selection? That always came back to, well, Matt, if you want to know that, then you have to analyze everything that's in the New York Stock Exchange and the Nasdaq, everything that's out on the market. That's the only way you would know how you're selecting, if that asset is the best possible selection. And then my professor that was interacting with me actually laughed at me because he told me I'd never be able to do that. Well, over the years, I've had a number of different jobs that have allowed me to build up that knowledge, some SQL knowledge, some knowledge of how to build websites. I mean, everything that you're interacting with, all those websites, I built them. And that's just through years and years of developing that core knowledge and understanding how to deploy it. So I do have a system. That's why I offer 7,300 assets. If you actually include two other exchanges within the US, I have the New York Stock Exchange and the NASDAQ. You include the NASDAQ GS exchange, which used to be the Amex exchange, and you include the over the counter, the pink sheets. You're talking 14, 15,000 assets. And that's really what my computer systems are analyzing is everything that's out there. But to simplify it and to make sure you make good selections, I limited what's available on my platform to just the New York Stock Exchange and the NASDAQ. They have a vetting process for who they allow to be listed on those exchanges, and that's going to help you, at least initially, better select more secure assets. Now, not everything that's out there is going to be a good investment or secure, but that's one of the filters that I try to leverage is that these big fancy people up on Wall Street that run the NASDAQ, that run the New York Stock Exchange, why not allow them to help me out with some of that filtering process to make sure that the assets that we're showing you that we're making available for selection are hopefully assets that will work out well for you over the long term. But in terms of selecting that, again, we have the fundamental metrics that we can walk you through. But beyond that, probably one of the most important things and one of the lessons I've had to learn over the last few years is about beta and understanding the beta of the assets that you're selecting. Beta is essentially how much an asset moves with the index. So a beta of 1 is just indicating that an asset moves very similar to the index. There are certain stocks that are out there that have betas that are very close to 1. And by leveraging them and by building a portfolio with a lot of stocks that the beta that's close to 1, and there's more factors to consider, but by having stocks with betas close to 1, ultimately your portfolio, provided it has a beta close to 1, ultimately what you're doing is you're building your own custom index fund. And I know I've gotten pushback on, well, why don't I just go and buy the index fund, Matt? Well, it goes back to being a shareholder, it goes back to voters' rights and being able to exert some control over these companies, whether that's the company that you work for, a company that you've always wanted to be affiliated with, or maybe it's a company or people that you just absolutely despise and don't like. Well, guess what? If you go out and you buy a couple of their shares, now you have voting rights in their company. And yeah, maybe your voting rights is this in comparison to some of the large folks that are out there. But I think, look at the GameStop story. I think that the power of social investing and the power of connecting a community online in order to accomplish a goal, it can be a very powerful thing. So, yeah, maybe you only have 2 or 3 shares, but maybe you go out and you find those communities that are out there. There are many where suddenly you can pull together 2 or 3 thousand shareholders that, yeah, they all have 2 or 3 shares, but combined collectively together, sure, maybe at the end of the day, maybe you're still talking about you own 1 or 2% of the company. But if it's 2,000 voices, I mean, think about it. A lot of the people that are running these companies, they're used to dealing with like 5 to 10 investors, and they're all from Wall Street and they work for the large firms. So the feedback that they get is from a very small circle. By you going out and purchasing the stock and then demanding that they listen to you, it really kind of democratizes investing and capitalism and it forces all of these people to pay attention to their shareholders. So if you like to vote, if you enjoy the power of voting, if you like the freedom that comes from that or that you gain by being able to vote for your elected leaders, You can vote for what's going on in these corporations as well, and understand even if you're not successful in trying to sway, the leadership team in one way or another, if you create a big enough story publicly, they still have to address it. So just some things to think about as you're going through selecting these stocks. A lot of people want to know what's the hottest stock. The hottest stock might be that company that you don't like. And by investing in them, maybe you can enact the change that you're looking for. You don't want those big coal producers to continue to build more coal plants. Go and buy coal mining stocks or go and buy those companies and then encourage them to get into other industries. All right, so moving in to some other aspects of cost and stats. One other thing to consider are the company financials. That's something that you should always be reviewing before moving forward with any investments. Do they have positive net income? Are their revenues growing over time? Those are some good questions to ask and to better understand before you make that investment. Some other areas to look into are earnings per share. That's how much did the company earn for every share that's out there, and then being able to leverage that as well, the price to earnings ratios, those can be good comparisons, EPS and the PE ratio. If you want to know how a company is doing against its peers, you can compare PE ratios and earnings per share to other companies within that same industry. A lot of times, what investors, when they're saying, oh, the market is overvalued, a lot of times they're just looking at a PE ratio and they're not really digging much deeper because they can look at a few different companies and see, maybe the industry average for the PE ratio is around 20, which means that the price that you're paying for that stock is 20 times their earnings. But maybe you have this other outlier company that's got some interesting technology or has created some buzz, and maybe they're trading at 30 or 40, price per earnings. What that's indicating to most investors is, well, if the industry average is 20 and they're at 30, their price is too high. They're probably overvalued at this point in time. So, you know what? Maybe the company's great, but I'm going to avoid them because of that one comparison. So, PE ratios can be very powerful as well. The other thing you need to consider is, are you purchasing a growth stock or a dividend stock? And if this stock is going to be paying you a dividend, focus on what's the dividend yield, okay? That's essentially like, for every $100 that you're spending on this stock, how many dollars are you getting back in return? And it can be kind of deceiving sometimes if you're not paying attention to what you're doing, because you might see one stock with a $5 dividend and you might see another stock with a 50-cent dividend. Whereas that stock that has the 50-cent dividend might have a higher dividend yield. That's all it relates to the share price that you're paying for that stock. So just something to pay attention to. And the other thing to keep in mind is when a stock does pay out a dividend, because they're paying value out of the company to the shareholders, the overall net present value of the company is lowered. So you're going to see the stock price, at least in the immediate and the short term, decline. Now, the company is going to work hard to bring that stock price back up to reestablish that value. But that value, you didn't lose the value, you were paid out that value in terms of a dividend. So just make sure you're considering those things as you're choosing your investments. Now, say you've pulled together a set of your investments, or a set of assets that you want to include in your portfolio. Now you're ready for pillar number 3, risk. The main thing, the main pushback that you're going to get from your average investor, your average broker, when you decide that you want to engage in stock investing is, oh, that's incredibly risky. You shouldn't do that. So if you're going to go down that path, which I know a lot of you really want to, and I've honestly, the vast majority of people that I talk to about investments, they're not really interested in buying all the fixed income products and all the other things that most of your brokers and investment bankers are actually offering to you, which are fantastic products, by the way, and you should consider them because they are much less risky than stock investing. But I know a lot of you, and I know that you want to invest in stocks, you want to know how to do that, and you're sitting there looking at all these big wigs on Wall Street running hedge funds and mutual funds that are telling you not to do it, but what are they doing? They're doing it. They're investing in stocks. So I know, it kind of sometimes it doesn't go over well when somebody tells you, "Hey, I can do this, but not you." So if you're going to engage in stock investing, pillar number 3, risk, is really the one that you need to understand how to leverage. So when I talk about risk, I'm talking about optimizing portfolios and diversifying your risk. So what is portfolio optimization? Well, it's this theory that you're trying to find the set of weights. So what you do is you take, say you have 10 assets, okay? A computer is going to come up with 10,000 random sets of weights. Oh, this asset and one of the sets is 2.5% of your portfolio. Oh, and this one it's 25% of your portfolio. So it's just going to randomly come up with a whole bunch of different sets of weights to create your investment vehicle. And then what the computer is doing is it's going back over time and it's testing those portfolios to see, well, how, if we had arranged it this way, how would that have performed? The optimal portfolio is the portfolio out of all 10,000 combinations that produce the most return while taking on the least amount of risk, which is what you want. That's the portfolio that you want to invest in. And by investing in optimal portfolios, more often than not, what you're going to end up with is a portfolio that has a beta close to one and that interacts a lot like an index fund, which ultimately is what you want because you want to take a lot of the risk out of stock investing. You don't want to eliminate it all because the risk is actually where you're getting your return from. One of the ways that you can begin to build your portfolio and identify risk, something that every trader was coached on, they had to get tested on this in order to get their licenses. And I know every finance student is taught this as well. It's called a covariance matrix. Now, essentially, what a covariance matrix does is it tries to figure out the risk associated with combining multiple assets together. So just know you might have 10 assets, and independently on their own, those 10 assets are great stocks. But when you pair them together, they might all move in slightly different ways, and it might actually be creating and generating more risk for you by combining those assets together in your portfolio. So what I did and what I created in my system is what I call portfolio grades. So, I briefly mentioned asset grades in the last slide that leverage those fundamental metrics and then convert them into a letter grade. Maybe I didn't fully explain that, but instead of looking at those individual numbers, I convert the greater population and their standing within that population to a letter grade. So that way, if you're trying to choose between two assets, it's much easier when you see, oh, this one's an A minus and that one is a B plus. You spent your whole life being graded over different things. You know immediately what that means versus a 0.58 and a 0.62. So that gives you a frame of reference for selecting the assets. But once you have the assets and you're ready to include them in your portfolio, then you can leverage what I call portfolio grades, which represent how much risk each asset is contributing to your portfolio, and that risk comes from the covariance matrix. So by understanding that calculation, by understanding that risk can actually be increased for your portfolio by combining certain assets together, those are all things that you need to consider, and they're not really all that well known. I know a lot of people that build stock investing portfolios that don't consider portfolio optimization theories and don't consider risk aversion. And that's something that you really need to be considering. Now, in terms of risk aversion, what's that? Well, it's really just fancy term to say you need to be dividing your portfolio between stocks and bonds. Now, I know a lot of people over the years have really kind of started to poo poo the idea of 60-40 split. And for a long time, that was a pretty good sort of rule of thumb. But what I've been able to do through my technology is offer you a website called riskaversionquiz.com. It's completely free. It's 8 questions long. It's a multiple choice quiz, and you just answer different questions that are based on certain scenarios, and then it calculates your risk aversion score, and that score helps you better understand how much of your assets should be in stocks and how much should be in bonds or rather low risk assets because you don't always need to purchase bonds or treasury bills. I mean, they can be um, pretty incredible in terms of a hedge against your stocks. So usually when stocks go down, the price of bonds go up. So a lot of times it can kind of help to maintain that balance in your returns in your portfolios. But there are a lot of other assets that are out there, especially if you're closer to retirement. You can consider fixed income products. I know a lot of the financial professionals would probably love to sell you those, and a lot of those are going to be great. I know a number of people that recently retired and then looking at the volatility in the market Some of them are having a hard time with it. Well, if they had purchased fixed income products or made that part of their overall portfolio, they wouldn't be feeling the pain quite as much. They'd have more of that guaranteed income. So that's really what risk aversion is understanding how to diversify your portfolio and invest in things that aren't just stocks. And that's important to understand is how do you branch out beyond that. So initially, I know a lot of you are going to focus on specifically stock investing, but once you become comfortable with that, you really need to branch out into other areas, including bonds, including even ETFs can be a decent hedge, just depending on what they cover. But also things like physical gold or certain commodities. I mean, you don't necessarily want to play around with futures contracts because that's more advanced and that's really intended more as a hedge for corporations. But physical commodities can be a decent thing to consider, and there's a lot of other products that your local bankers, I'm sure, would be very happy to kind of help you find. I mean, you can purchase certificates of deposit. That's something that for a number of years had interest rates, I mean, close to zero. Now they're like 3 or 4%. So you really can do all right by investing in those products, and especially if it's a volatile time in the market. If their expected returns are, say the expected return is 3.5% for a stock. If you can get 4% on a CD, or you can get 4.5% on a T-bill or a treasury bond, there's another concept called a risk-free rate. And there's this concept of a risk premium, which goes into two of the fundamental metrics, the Trainer's measure and the Sharpe's measure. And that's just understanding, hey, is the investment that you're paying you a rate above these fixed products over here? Because if it's not, then why are you choosing it? Because your money can earn more money if you pick that product over there. Sure, there's the possibility that the price could rise, but again, that goes back to risk, and that's the thing that you're trying to mitigate leveraging this pillar. All right, so moving on to pillar number 4, which is regimen. So, say at this point you've been able to construct your portfolio and you have it together. Maybe you've moved forward with making some of those investments as well. So, great, you've been able to pull together a stock portfolio, you've properly optimized it, you've, addressed risk aversion, and you've got proper levels of diversification that you've integrated into it. What's next, right? You can say, well, hey, I've got a portfolio out there. Oops, maybe it's not performing quite as well as you had hoped it initially would. That's really where, regimen comes into play because ultimately, with how you invest, consistency in terms of your method or your process is key because that's going to allow you to develop a feedback mechanism. It's going to allow you to refine things over time by having a system. If you're just simply going out there and picking stocks, it might work. You might get a little bit lucky there initially, but eventually you're going to kind of hit a wall where you feel like you don't know the proper things that you need to understand in order to really kind of broaden out and maintain things over time. So that's where the regimen pillar really comes into play. It's all about, understanding the market, how to monitor the market. You need to make sure that you're um, benchmarking indexes like the S&P 500, the Dow Jones, the Nasdaq Composite. Those things can help you better understand what areas of the market are performing well. Is it technology? Is it industrials? And it can give you an idea of maybe where you should park your money because if technology is getting beaten down pretty well earlier on in the year, then maybe that's not really the best place to put your money. But if you feel like everything there is undervalued and maybe there's some reasons why, that can also be an indicator of okay, hey, there's current sector of the economy that's undervalued. Maybe I want to jump in there. But by understanding how to identify those different economic level factors or even just the different indexes that monitor industries or sectors or overall areas of the market, that can be very helpful for understanding where the money is moving to and why, and help you better prepare your own portfolio to avoid some of that risk. Some other things to consider are like the treasury yield curve. We talked a moment ago about, including bonds in your portfolio. Understanding where that treasury yield curve is at and what you would consider to be a risk-free rate is very important for understanding which investments you should be choosing because you really should always be looking at that risk premium and whether or not it's positive. If it's not positive, then just go with the treasury because you can earn more money there and it's essentially guaranteed. Although, I know we all have our opinions about how the government is working. But ultimately and historically, those things have been guaranteed and they've been paid. Now, when say you're studying the market and you've got a couple new assets that you're considering, when you're identifying new assets, you'd identify it just the same way as the ones that you're including in your portfolio. But at this point in time, you don't want to just throw all of them in your portfolio. Put them in a watch list and start monitoring these stocks. You might even, on my platform, Portfolio Examiner, you can build virtual portfolios. They're not linked to your trading accounts or anything like that. So if you want to try out two or three different versions of a new portfolio, you can build virtual portfolios on there with the assets the way that you think you want, and then you can monitor that portfolio over time before you move to it to see, hey, is this asset that you've created, is it really moving in the way that you want it to? Is it going to help you achieve those goals? So, leverage platforms that allow you to build virtually in order to test things out before you move into them. But make sure that you're maintaining watch lists, and even, when you read or hear something like in the news that you think sounds interesting, it's worth looking a little bit deeper. Who's the company? Who are the people that own this technology? Why is it coming out? Is this new? Because digging into those situations, maybe you don't ultimately end up including that company in your portfolio, but you might find that they're great to have on your watch list and to keep an eye on, because maybe a year from now, maybe their financials are positioned a little bit better, and maybe at that point in time, it makes sense to include them in your portfolio. So don't be afraid anytime you hear a headline or you're reading something in the news and you think, oh, that's really cool, or that's really interesting, or oh wow, this company is going to go under doing this. This doesn't make any sense. You can leverage those news stories by adding those stocks to your watch list and just seeing how they perform over time. So identifying those new assets really important for portfolio maintenance, because you're not going to be maintaining the same set of assets, over the long term. You're going to be moving in and out of different stocks. And if you don't believe me, look at somebody like a Warren Buffett. There's a number of stocks that he's owned for a long time, but then there's several that he moves in and out of every single year. And it's because he and his team are great at identifying that value and understanding when to move in and out of those other assets. And that's something that you need to learn how to leverage as well. And then from there, say you've developed those virtual portfolios, you've tested them, you're very comfortable with all the outputs and everything that you're seeing. So now, okay, you're ready to move to it. Well, when it comes to portfolio rebalancing, the first thing that I would tell you is, before you sell any assets or move anything around, go back to your portfolio with the assets that you currently have and find your optimal portfolio. Hopefully it's been at least 2 weeks since you engaged in that initial transaction, but go back to your original set of assets, find that optimal portfolio, and figure out, hey, has it changed? And if it's changed, is it pretty minor? Is it just a little bit, here, a little bit there? Maybe sell one or two shares of this one or two shares of that one. Is it a pretty minor change financially in terms of the greater scheme of everything? Or is it a very dramatic difference? And what you want to do is, if there is a dramatic difference or there is something that has really changed that's material, then you need to consider whether or not you should rebalance and move to that portfolio. And we'll get a little bit more into it in one of the later pillars. But if you're going to move, if you're going to make those transactions, you need to consider things like taxes, penalties, fees. Because if this is just a stock trading account that you have, that's an after tax account, it's not a big deal. You just might end up paying some capital gains tax on some of the stocks that you ended up taking gains on. Now, that can be offset by other stocks that you might be taking a loss on at that point in time. And those are some of the things that you need to kind of consider. And we'll get into that a little bit more in that logistics pillar. But ultimately, what you want to do is you want to develop a good regimen for yourself. Now, I have the portfolio degree program that can kind of help you build that baseline. But ultimately, what's going to work for everyone is a little bit different. And don't be afraid to try out different training programs, to try out different methods, to figure out what works for you. The only thing that's not going to work is not learning anything. If you're just going to come out and buy stocks and sort of forget about it, you're not going to beat the market. You're not going to do very well. I'm somebody that I've studied this very intensely for the last 13, 14 years. I've got all these test funds. I've got all this technology that I've built. And, I'm not a great investor. Every year I've been able to do better and better and better. And my returns have been very similar to the indexes the last few years. And each year I've been able to get kind of continue to close that gap to get closer and closer to the index's return. Now, the vast majority of the people that are out there that you're going to try to buy investment training programs from, they're going to tell you, oh, I made 500% last month, or I made 200% doing this, or I made 150% doing this. Look at the risk associated with what those people are taking on, because I've seen it before. You don't necessarily want to take a trading strategy from a 22-year-old that is okay with taking on a ton of risk and has essentially made a bunch of bets and gotten lucky and it's worked out pretty well. You don't want to necessarily leverage that strategy for, somebody that's in their 50s that's only a few years away from retirement. You don't want to be taking on lots amount of that ton of risk. You're going to sit there and you're going to look at it and go, oh, but they made 150%. And if I could just do that once, well, then I could retire from my job. Well, yeah, but if it halves and it goes in half, maybe you're working for the next 15 years instead of the next 2 years. So just make sure you're taking risk into consideration when it comes to your investments and when it comes to considering all these programs that are out there. If you want to come and join my program, you're going to grow money slow and steady. It's not a get rich quick scheme, and I can't promise you returns. I can't promise you anything tomorrow. I've got on this one page, linear returns are a conspiracy. And if you're familiar with the flower of life and all of that, then I'm not going to go any further with that because it gets kind of funny. But if you want good returns, you have to develop a good regimen and you have to take ownership over what you're doing. Then from there, it's all about really how do you embed quality into your portfolio. That's pillar number 5 is quality. So again, I just mentioned a moment ago, when you make that initial investment, don't have an immediate knee-jerk reaction. Don't pull your money back out. Don't go and sell those assets that maybe took a 5% dip in the first 3 days that you bought them. Don't. Wait. Wait until emotion is no longer part of what you're doing, because when you start trading off of emotion, that's when you lose. What you want to do is you want to review performance, you want to stay calm, and you want to properly assess what's going on. Not only your overall portfolio's performance, but the individual assets. A lot of times people get stuck on the individual assets and they go, well, this stock and this stock are losing, or they lost me 10% over the last 2 weeks, so I need to get rid of those. Yeah, but how did your portfolio do? Is your portfolio maintaining a market-based return? Is it beating the market? Because guess what? If your portfolio is beating the market, you can sit there and complain and say, "Oh, it should have done better if these other assets had done better." But that's what, when it comes back to understanding risk and that covariance matrix and what is adding risk versus taking risk away, the first thing you need to be looking at is your portfolio's performance. And that's where I lose a lot of people. A lot of people will want to look at this stock or that stock, or they want to jump right into, oh my gosh, this stock over here, I lost 30%. Well, yeah, but these 5 over here, you gain 10 to 15% on each of them, and overall your portfolio is positive. So who cares? All that happened is on that stock, your expected return went up. So you've got more potential with that one. Is it risky? Yeah, it's risky to hold on to. But what you might find is it might be even more risky to, redo your portfolio and to move into new assets. So, you want to always be driving for quality in your portfolio. And the way that you can better understand if your portfolio is quality is by coming up with a bunch of different alternatives. A moment ago, I talked about how you can create virtual portfolios on my platform, Portfolio Examiner. Come up with a bunch of different versions of your portfolio with including different assets. See how the optimizers try to build them and try to understand which ones align with you, which ones don't, which ones surprise you. Maybe you added an asset and now it wants nothing to do with it. It puts 0% investment in it, or it tries to shy you away from it. Why? And understand why. And then track these things over time to see their performance, because the more it's like anything, like I said, I came from manufacturing. And when you're piloting a new product, it's messy and there's a lot of mistakes. But over time, you hone in that process more and more and more. You become more regimented. And what do you do through that regiment? Well, you can drive quality. So that's really what all of this is about, is understanding what's going on within your portfolio and not necessarily just looking specifically at the assets. But when you do and you see those winners, assess it, okay, hey, they won, but did they outperform? If their expected return was 8% and they're at 12% and you've held on to them for a month, how do you think the rest of their year is going to go? Because more often than not, the market tends to be cyclical. And yeah, you might be up 12% today, but 3 months from now, you might be only up 6%. And then, you know, you get to the end of the year and you ended up with an 8% return to an expected return of 8%. So those are things that, investors consider. They don't always make their moves based off of that, but it's all things to help you better identify what's going on within your portfolio and whether or not these companies are still well positioned to grow or not. Because if you look at some of the losers, especially the ones where the price went down, if it's due to them paying out dividends, remember you're getting that dividend. So check the cash in your portfolio. But you can also do what's called DRIP, a dividend reinvestment program, where it just automatically reinvests those dividends into more shares, which is highly recommended to do because then you're not you're not enticed to touch that money. It just rolls it back into the asset, and then when you are ready to rebalance, you have an asset that you're selling rather than a cash stockpile that you're then integrating into your portfolio. And then, ultimately, when you're looking at your portfolio, make sure you're gonna set goals. You're gonna have goals with your investments. Make sure they're clear. Make sure they're measurable, but also understand when you're recognizing your reality, learn to appreciate where you're at and how far you've come. Um, it's important to celebrate that, to celebrate your progress, because the vast majority of the time, whether you're in a manufacturing environment, whether you're building a portfolio, or whether you're working on Wall Street, you and I know that every single day there are certain times in that day where it just feels like complete failure. And you have to learn how to grow, how to get beyond that, and how to continue to progress towards your goals. You have to shut that world out and have a laser focus on what your goal is. But then again, appreciate how far you've come and recognize what you do have, because that will make you feel good about where you're at, or it'll help you make an assessment that you need to change some things. So just be honest with yourself, and that honesty, if you need to meditate on it or whatever, be honest with yourself about your portfolio and whether or not you're actually including quality assets or whether or not there are better things for you out there to leverage, whether that's not investing in stocks, or it might be companies that are in, maybe you own a certain company and you've been looking at that industry and you find out another company within that industry interacts a lot better with your portfolio. So those are just things that, as you become more comfortable with all of this, you'll start to begin to identify and actually start to get really good at, and that'll help you drive quality. Now, getting into logistics. This is something that, if you know manufacturing, logistics is probably the biggest pain, and it's I don't know that it's necessarily the most difficult thing to do, but it is a very difficult thing to analyze and to understand. Now, I get it, for a lot of you that don't work in that area, you think, well, you're just taking something from point A and delivering it to point B. It's the movement of that object, that item. Well, as it relates to investments, you're talking about, hey, maybe you have to pay some fees, or associated with, maybe there are certain funds that you want to invest in at certain um, investment brokerage firms, but maybe they come with a 1% or 2% management fee. Now, if you're an hourly worker or you're a salary worker, you get paid, every 2 weeks or once a month, or you get paid based on the number of hours that you work. Same thing. These investment bankers, they don't get paid based on the number of hours they work. Most of them work 60 to 80 hours a week or more. These guys are generally workaholics. So how do they make their money? Well, they make their money off of fees. So if you have to pay a fee, that's not necessarily a bad thing. I know everybody wants to avoid the fees, they don't want to pay the fees. That's fine. But when you are going to pay a fee, make sure you understand what you're getting for that cost that you're sacrificing. You're paying for a service. So make sure that they're providing it. And if they're not, then maybe it is time for you to think more independently, or maybe it's just time for some different products. But of course, I think a lot of you are probably here today because you want to eliminate fees. You want to invest in the stocks directly yourself. Certainly, you can do that. I can help you do that. But ultimately, just know that that fee can lead to something good for you if you're working with the right people. Now, I've met a lot of people that are sort of bigwigs in the investments industry. And honestly, I think you might kind of demonize some of these people because they make a lot of money. Most of them are very respectable, very polite, friendly individuals that are really easy to work with. So don't be afraid going in there and working with them. But at the same time, if they feel kind of sleazy or salesy, or you really just don't like the vibe that they're giving off, don't work with them. There's a lot of people out there that you can work with, and there's a lot of products that you can choose. Now, if you're, say, a salaried individual or somebody that's been able to invest in a 401k over a longer period of time, maybe you're closer to retirement. Okay, if you're going to move that money around, you need to understand the penalties that are associated with moving that money early. And you also need to understand, especially if you went the traditional route, the type of taxes that you're going to incur in order to pull that money out. And that's another thing that whether you're ready to retire and you're ready to pull that money out, there could be taxes. If you're somebody that draws Social Security, keep in mind you can only draw so much out of your investments before it'll start to, lower the level of Social Security that the government is giving you, and that's because your earned income is high enough through your investments that you don't qualify to get Social Security. So there is, if you're somebody that you want the Social Security, you paid into your whole life and you want to make sure you get that, but you want to have a nice lifestyle, then work with a financial professional and they can help you find that perfect medium where you can withdraw a nice amount off your investments, you can pull your Social Security, and you can have that comfortable life that you've earned without having to pay a bunch of taxes and penalties and fees. And that really is where financial professionals can come into play for you, is helping you better navigate all of this, all of the taxes, all of the fees. Something that you may not have ever even considered is, how is the transaction being handled? If you have a 401k and you're moving it from one firm to another, is it an electronic funds transfer? Are they mailing you a check? Um, we've got things like Bitcoin now, and these blockchain ledger systems that are out there, which are great. They're public. I think it's a wonderful technology, but it's still sort of in the infant stages of regulation, of trying to understand how to regulate these things. And we don't necessarily know how the governments are going to interact with them. So it's still pretty risky putting your investment in some of those things. Now there's, a whole mountain of people on the internet that'll disagree and tell you to go and invest in Bitcoin. But again, it's not necessarily a secure asset yet. It might be the future. It very well could be, but it's not necessarily something that is super secure. Now there's a lot of people that are investing in it, but just be careful where you park the money. A number of years ago, an individual that is very prominent in society was pitching a platform that they invested in order to purchase Bitcoin and other types of um, cryptocurrencies. And I jumped on that platform and I didn't put much money in. It was a couple $100. But shortly after, the whole platform went belly up. There were all these lawsuits. I lost my money. I've still received notification that I can get some of it back, but just a small amount, anyways. So it's never really bothered me that I lost it. But it was a major platform that was promoted nationally by some very prominent individuals, and then suddenly it went belly up, and all the money that I had put into it was gone. And in order to get that back, I have to jump through hoops. I have to talk to lawyers. I have to sign up for lawsuits. And for me, the amount of money that I had in just isn't worth it. But, how the transaction is being handled is something you've probably never even thought about, but it is an area associated with investing that can get you caught up if you're not careful. Keep in mind that if you're keeping money in a savings account or a checking account, those things are FDIC insured. If you're trading with the money, you can go and buy insurance, but there's no guarantees that you're going to get that money back if you put it with a platform that's not super well established, and suddenly they disappear. Now, in order to get your money back, if you even get it back, you're going to be, inundated with legal costs and legal fees, and none of that none of that is a good thing to be engaged with. It's really just draining to have to work through stuff like that. But if you are going to move forward, say you've got say you've got something coming up in your life and you need to take some money out of your 401k, and maybe that means that you're going to have to pay taxes and penalties. Well, just understand, how long is it going to take you to earn that money back? How long is it going to take you to earn the taxes and penalties back? And then over the long term, over the next 10 to 20 years, however long you wanted to hold on to that money before retirement, how much more in terms of the time value of money would you have had you not engaged with that transaction? Because that's the amount of money that you should be focused on figuring out how do you earn it back. Now, getting into more the growth area of these pillars, this is pillar number 7, which is early adoption. Now, I was born in the 80s. I grew up in the 90s and 2000s. And I remember the days of seeing Corvettes and fancy cars with custom license plates that more or less said Microsoft. Because some of the early investors in Microsoft, or even Gateway at the time, I know I'm dating myself, but a lot of the people that invested in those companies early on created those 10x returns that everybody's looking for. And then they were able to cash in some of those investments and buy those fancy cars and enjoy sort of a nice lifestyle associated with having owned that investment. But a lot of people that I talk to want to know, well, Matt, how do I do that? How do I identify those assets? And it really goes back to understanding a lot of those journals, like the peer-reviewed publications that are out there that scientists and people that are in technology leverage for a lot of times publishing things from universities, but they can also be the more entertaining ones where it's just like Popular Science, for example, had this article back in the 90s about future cities with these little electric vehicles and skyscrapers that were hydroponic gardens and all the stuff that for 30 years still fascinates me. And I still think that that is our future. And there's a big part of me that wants to know, how do you get there? How do you do that? How do you support those things? And that all comes from the inspiration from those magazines. So if you want to know what the future is, even sci-fi, look to see what people think is going to be the future in some of these futuristic movies, and then are there products out there currently, and is there some early adoption going on? And something you have to remember with early adopters, there aren't very many of them. There's just not. So even though a product might have a low adoption rate, it doesn't mean that it has low potential. So certainly consider that. Just because there's only a few early adopters doesn't mean that when this product hits the mainstream that it won't blow up. But those types of magazines, those types of publications can be incredibly valuable if you're trying to identify what's next. Now, some of the other aspects that you can leverage for finding out what's going on is social media. A lot of the companies that you're going to invest in, you can follow the CEOs, you can follow the vice presidents, you can follow sometimes the board of directors, or even the majority shareholders on these social media platforms. Pay attention. What are they posting about? What is the company posting about? What are they highlighting to people? What do the comments say? Do their employees react to it? Is that reaction positive? And then you could even look at their job boards. What jobs are they hiring for? Are they entry level? Are they mid level? Are they upper level? Why? Are these jobs that you see reoccurring on a regular basis? Is it something that there's a large population in that company that does that particular function, or are they burning through people? Are the employee reviews on employee review sites positive, or are they very negative? Because if you think about it, if you could have a product that's a great product, but you go and look at the company and they're burning through people and the reviews are negative, that's probably, even if they're a publicly traded company, that's probably not a company that you want to jump on that bandwagon early on. You want to better understand, what are the characteristics, the values of the company, and how are they building to mostly better understand if that's a good investment for yourself and for your portfolio. And social media can be a great way to find out those things. Now, I know a lot of people will be negative about LinkedIn, and I think we all know that those one or two people that you worked with over the years that have those really annoying political posts that they'll put on there that they're just ranting about things. Ignore that stuff. Just focus on the people that run your investments, on what they're doing and what are they posting about, because that can give you some really incredible insights into what's next for that company. Now, if they are publicly traded, they have to be very careful about their announcements and how they make them and when. But pay attention to that, because you never know when you might see something on social media and the market doesn't even react to it for a few days. That happens quite frequently. Another area, two other areas to look into would be venture capital and AI. Now, in terms of venture capital, there are venture capitalists all over the place. They're not just in Silicon Valley. So think about it. What are they focused on? Who are they investing in, and why? Now, they're always investing in not publicly traded companies. So, a lot of times you can't get your hands on the companies that they're investing in because you're not an early investor. But look into what are they investing in? Is it a certain type of technology? Is it a certain function that they're trying to improve or enhance for people throughout the daily life? Is it certain maybe beauty products that they've arrived at that, oh my gosh, this is a new way of doing it and it's revolutionary. It's going to change the industry and they're early investors. Trying to keep up with them is not something I'd recommend, but paying attention to what they're doing, where they're investing, and why can be very valuable to helping you figure out where you should be looking for that early adoption and those early products before they become mainstream and hit that 10x return. The other thing you can do today, there are AI tools all over the place. Ask AI. Talk to AI about trends. You can sit there and have a conversation with AI about different things that are going on, about trends in certain industries, about who are the key players, why. AI is full of information. Leverage it for yourself. Don't just go there and say, hey, what's the next 10x stock? It's not going to know what to tell you. It's going to search through some social media posts and probably tell you, regurgitate some junk that somebody else posted. But if you want to really understand, hey, I saw this product. Can you tell me a little bit more about it? It'll elaborate for you. Hey, is this the only company that produces this product or are there competitors? It'll give you an answer. Hey, are there competitors that are better positioned for market share or who, has the best market share right now? And you can keep digging deeper and deeper. Oh, out of the companies that you've highlighted to me, are there any that are publicly traded? Oh, this one and this one. Okay, out of the two that are publicly traded, which one had positive net income recently? And you can endlessly do that, and you can just keep asking questions and questions and questions of AI. Now, AI is not a financial professional, so I would always recommend going and interacting with financial professionals before making those investments. Don't just do what AI is telling you to do, because AI is just reading what's on the internet, and not everything that's on the internet is necessarily trustworthy. So, take it all with a grain of salt, but leverage the tools that are available to you. All right. Pillar number 8, people. So I touched on social media a little bit in the last slide, but for this pillar, more so what I'm talking about with people is it's about building a network of people around you, people with similar hobbies or similar ideas about how to invest or the market. You can find endless number of Facebook groups that are out there. There's on X, there's all sorts of communities. There's some really great people that host spaces that are out there. There's this one, Wolf Financial. You should definitely follow them because they pull together a lot of industry experts on calls every single day. And the depth that some of these people talk about these things is really remarkable that they're doing it in a setting that is free for everybody to listen to. So I'd highly recommend engaging in some of those communities. As well, Reddit is a really good resource, a really great tool for trying out different things. And it's a great way to get feedback. If you're a fan of the Am I the Asshole thread, as you know, people on Reddit are not afraid to give you feedback and let you know what they think of you and your ideas. So certainly going there and trying to get sort of that feedback mechanism. If you don't have a big social group or large group of friends that you can leverage, sometimes going to those online communities and posting questions or trying to interact with others is good. Just don't send them DMs trying to sell them Bitcoin. Nobody wants that. But if you reach out to certain people, even investors that you might think are untouchable, or that if you reach out to them, they're not going to reply to you, you know, the reality is okay, if you're reaching out to the CEOs or you're reaching out to the bigwigs, they're probably too busy to reply to you. But if you go one or two levels lower and you're looking at some vice presidents or you're looking at some of the people that support the major functions, those people don't get contacted from outside parties a lot. So, all of a sudden a new message pops up in their LinkedIn DMs or something. They're going to be curious. They're going to look at it. Now, they might not give you what you want or give you the interactions that you're looking for, but that can be a great way to try to engage and even sort of cold call. Back in the day, we used to cold call people, and you'd open up a phone book and go one phone number at a time, which can be a brutal process. But today we have all this social media stuff that you can leverage. So really try to build a network of those like-minded people on there. And then, I keep talking about social media, and you can follow all these people. Years ago, this phrase came out, well, businesses are just people. And I don't agree with that from a legal status standpoint, even though that is the law. But businesses are just a collection of people and computer processes and functions that help to achieve goals or resolve problems. So at the end of the day, there are people in charge of all of these different functions. So if you want to know more about something, don't be afraid to reach out to the people at those companies that are running those specific functions. You might be surprised. A lot of them might even be willing to have video calls with you and tell you a little bit more about what's going on behind the scenes. Another thing that can be incredibly valuable are your hobbies. Now, you might be obsessed with investing. Maybe you want to spend all of your free time, all of your nights and weekends trying to find the next best asset. Don't do stuff like that. Take a break, walk away. Hobbies have been integrated into our regimens over the years for a reason. It allows us to de stress, it allows us to relax, it allows us to disconnect from the core elements of who we are on that Monday through Friday or whatever shift you work. But getting out of those elements and getting into the things that help us feel free and give us that freedom, whether you like playing golf or tennis, or maybe you want to go to the bocce ball courts or whatever is your thing, leverage those hobbies to help you build that network. That's where you're going to find those like-minded people. And believe me, there's probably more millions and billions of dollars that have exchanged hands through deals on golf courses over the years or in country clubs than probably have in boardroom. That's honestly where I cut my teeth years ago, was as a golf caddy. When I was 13, my older brother had done it and I always wanted to go out there because I just loved golfing. But what I realized as a caddy is you're every day you're rubbing elbows with doctors and lawyers and business owners and all these people that are affluent and at a certain position in society. And I always wanted that for myself. But over the years, I've realized that a lot of how those people maintain that status is through networking at social clubs like that. So don't be afraid to be social. Don't be afraid to talk about your ideas, to express what you're interested with to others, because you never know who's that person or that person who's a friend of a friend that can make that connection for you that can lead to just incredible success. So, a big part of investing is about building a community. Of course, I have like my YouTube videos and the different things that I do online, and I'm trying to build a community by having leaderboards on my website and trying to encourage you to challenge your friends to get them on there as well. So that way we can all compete and learn from one another. But it's up to you and what works best for you. Just watching YouTube videos, that can be a wonderful way to get engagement as well. Now, it's one sided because you're just watching videos, but you should always want to be learning from others and you should always want to be engaging with others. So, and the little note that I have down here at the bottom, it's all about who you know and how you network. And whether that is about career planning or going up the ladder at a corporation, or that's about building your investments or just building a community, that's good advice. It's about who you know and how you network, okay? Because that can be a major factor in your success. All right, getting into the last pillar, pillar number 9, which is feedback. This is the part that not everybody is comfortable with, but it can be very good for you. And it's a main part of why you want people, why you want that pillar number 8, is because you want to have a way to get feedback. Now, what I would highly recommend is if you're doing all of these trades through a financial professional, that is probably the best source of feedback that you can get, because you're consistently interacting with somebody that's a professional at doing this, and they're going to really help you avoid pitfalls and certain things that you're not considering that they've seen before. They've been there, they've done that. They're schooled on it, and they're there to help you avoid some of those things. So really consider their advice. Like I said, my background is in corporate finance, and it's in understanding how to analyze and build financial statements. And then ultimately, I've studied investing for years, more so as a hobby. But as I've gotten into coaching that that corporate finance knowledge has really come in handy, because as I interact with a lot of investors, a lot of them actually believe all those corporate financial statements. And I'm somebody that is very skeptical, as somebody that's built them for years. And I'm not saying anybody that I ever worked with or anything that we ever did was nefarious or we ever lied. But when you're working with things like accrual based accounting, it can get complicated in terms of trying to peg down what you should recognize when and why. And there are certain ways that you go about that. And then there are certain ways that within reason you can actually manipulate that just slightly if you're trying to drive a certain result. And I've seen it a number of times over the years, and it's always made me very uncomfortable. And it's one of the major reasons why when I'm reading corporate financials, a lot of times I think they're bullshit. I want them to have increasing revenue and I want them to have a net income. And I want to hopefully see that net income increasing. And if it's not, then there should be some good reason why. But what I would rather do is read like their annual report, follow their C-level people on social media to see what's really that heartbeat of that company, and then even check in employee reviews. Are they really a reputable company, or are there some folks out there sort of blowing the whistle, saying that there's some things going on here that aren't necessarily what you would expect or what you would want, as an owner of that company. And that's something to really consider as you're purchasing these stocks. You're an owner in these companies, so act like it. But as you work with your network, you want to make sure that you're surrounding yourself with the types of people or the people that are where you want to be. And one of the biggest factors sometimes in getting there is identifying and picking and working with a mentor. Now, this can be formal, this can be informal. There are certain people out there that you can pay and they'll be your mentors. There are certain people that will just be a mentor for you. And then there are other people that maybe they're a mentor for you and they don't even know it. It's just you call them every once in a while, you bounce some ideas off of them, you interact with them, they give you some good feedback, and then you'll talk to them again in a couple weeks or whatever. But it's not a formal thing. So just know that the mentors that you want to find, those are the people that they've been there, they've done that, they've walked the road that you're about to walk down or you are walking down. And those are the people that you want to seek feedback from, people that have done it before. I've talked about my investments and my returns. I mean, I've earned a return every year that the S&P 500 has been positive. But in the first few years, I've been doing this about 6 years. The first 2 or 3 years, we're talking single digit returns. When the market is producing like a 20% return, which that can hurt. But that's where having a mentor, getting feedback from others. Oh, I wasn't factoring in beta. Oh, I wasn't looking at this the right way. Okay, let me fine tune these things. And that's something that with my tools, I've always been open to changing them and open to modifying them over the years. But I think over the last 6 years, what I've arrived at is a very, very effective way to do it. And last year, my return was very close. The S&P 500 was just over 20%, and I was just below it. So I'm really close to being able to replicate that return. But again, it goes back to my regimen over the years and how I've changed that. But also, I'm not here to promise, like I said earlier, I'm not here to promise you some get rich quick scheme. I'm very transparent about who I am and what I have. I'm a thinker, I'm a creator. To me, it's all about the logic behind this and how do I arrange things in a way that are logical that help me understand things. I'm just a regular guy, just like anybody else. Granted, I have an MBA where I studied finance and economics, so it gives me a different lens to view things through. But that was probably what led me to the most success being in a manufacturing environment is I'm just another guy. I'm not some, you know, um, super stuffy, ego-filled person that thinks that, you need to look up to me because I'm a controller. No, you have a problem, bring it to me. Let's talk through it. Let's figure out what's the right solution. Oh, the solution is you need $5,000. Okay, let's talk through it. I can't tell you how many times people were afraid to bring me solutions because it was going to cost a little bit more than the current status quo. But guess what? The solutions, oh, you need a different filter. This filter is 50% more. Oh, but it lasts 4 times as long. Okay, we'll tell you what. I'm going to trust you this time around. We're going to get your filter and we're going to see if it lasts 4 times as long. But guess what? In the future, if it doesn't, I'm not going to trust you when you bring me other ideas. Ultimately, it was that holding them accountable for their actions that allowed me to unlock a lot of different things within the plant and figure out how to drive savings in ways that most of the time leadership is not interested in because, oh, well, this costs a little bit more. Well, it costs a little bit more today, but look at that life cycle cost. And is it going to lower that cost over time? And there were a number of times that I made decisions that did. Well, that's what you want in terms of building a network and being open to criticism, is there were so many times those folks were apprehensive to bring ideas to me. whether they thought I was going to be critical or they thought I was going to tell them no. But after a while, they realized that no, he welcomes these conversations, even if it is critical or they're critical of me. Because sometimes I would make decisions and they go, no, that's the wrong thing. You should have done this instead of that. Well, by being open to that criticism, by being open to that conversation, now I know I wasn't a maintenance professional. I'm not an engineer. Come and educate me and help me understand how you view things and why I should agree with you. And as long as you're open to that, whether that's with investments or career pathing or whatever, by building that network, by having that source of feedback, you're always going to hear the things that you need to hear in order to make the corrections so that you can continue to be successful and prosper. So that's really it in a nutshell, in terms of the different pillars, in terms of this world class in terms of this world class investing concept that I wanted to convey to everyone. Now, ultimately, I did this like a week or two ago. I just created a chart and put it out there just for fun. This was just something that I thought was just fun to do. But as I started to work through it, I realized that it was a very powerful tool for communicating a lot of the concepts that I coach, and that the concepts that I coach are also can act as a foundation for all of this. So it's really kind of blown me away how it all links together and works together. So be sure to go to my sites and check them out. Like I said, Portfolio Examiner is completely free. You can go there and build portfolios. Create an account. That'll unlock all the tools. I don't sell your email address. There might be some ads on there in the future with things like brokerage firms advertising their services. I've tried to avoid ads because I didn't want, a company to come to me and say, well, you've got us as a B plus on here. If we spend 50,000 in ads, can we be an A? I wanted to completely avoid all of that, which is why there's no advertising on there right now. There might be some, like I said, in the future, but they would be companions that I could work with. It would be brokerage firms or investment houses that I could relay people to for actually making those investments. So certainly, if you work for one of those companies and you're interested in working with me, I'm always open to that. There's even been times I've been contacted about training individuals that are becoming financial professionals and actually managing other people's money to trade. Now, I don't offer training for different licenses, but this is just kind of broad strokes, general training to build that ultimate foundation that you can grow from. And really, I hope this is a starting point, a launching point for a lot of you because investing is really a remarkable thing to be involved in. Being a shareholder, being a business owner can be an incredibly empowering experience. And it's something that I hope all of you one day get to enjoy. And if you're not in a position yet to invest, if you're not in a position yet to go and purchase the training videos, there's a lot of free content that I have out there as well. You can check out all those tools at portfolioexaminer.com. Or if you want to understand your risk aversion score, you can go to riskaversionquiz.com and that'll give it to you. Or if you're curious about my training videos, go to portfoliodegree.com and you can watch a bunch of previews that are on there. That'll give you the gist of just what all is covered there. There's actually quite a bit that I cover in those videos, and like I mentioned at the beginning here, it's something that I spent about 2.5 years working on. This video here was really just kind of off the cuff, whatever came to me as I was looking at these slides and pulling this information together. And if you guys like it, subscribe, like the video down below, share it with your friends because believe me, it's 7 ways from Kevin Bacon. If I can get 3 or 4 of you to just share and like this video, it'll help get it out to thousands more people, potentially even more than that. And that's really how you can grow and make an impact for me is by liking and sharing this video, by subscribing to my content. I'm going to have a lot more shorts coming out here pretty soon that explain a lot of the more basic concepts that I coach. As well, there's going to be some more videos that I come out with that kind of expand on these world-class investment pillars. I think that'll be something that is really interesting because for the folks that have joined this video that have a background in world-class manufacturing, as you know, with each of those pillars, there's different 7-step methodologies, there's checklists, there's worksheets that you can work through that help you accomplish those goals. And I think that there's definitely potential for those types of things here. It's just a matter of time and pulling all that together. But be sure you're out there supporting me. I'm here supporting you, and I appreciate you being here today. Have a great day. Hope you learned something. Take care.